The Nigerian exchange suffers biggest daily loss in months as sell-off hits banking stocks. Nigeria's March inflation rises to 33% amidst naira appreciation. And Mozambique cuts rates twice in 2024, leading African growth charge. These are the talking points on the show today. Welcome to Business Edge. I am Perpetua Fasami Peter. We begin with stories from across the continent. Stay with us. The African Development Bank, AFDB, has released a report outlining the legal framework, procedures and governance related to a call on the callable capital by the institution. Callable capital refers to the part of the bank's capital that is subscribed by shareholders but not immediately paid. The report details the conditions leading to a call on callable capital, as well as the processes for initiating such a call by the bank and its fulfillment by shareholders. This initiative was prompted by a G20 recommendation following an independent expert review of multilateral development banks' MDB's capital adequacy frameworks and aims to provide credit rating agencies with pertinent information for their assessment of the value of callable capital. The report also presents the results of a reverse stress testing exercise conducted on the African Development Bank, assessing the likelihood of a scenario where the bank would need to call on its callable capital. Nigeria is encountering challenges in finding buyers for its crude oil, with more than 30 of the scheduled cargoes still seeking buyers, according to traders specializing in West African crudes. A total of at least 53 cargoes are set to load from Nigeria next month, with most consisting of 1 million barrels each. The pace of sales is closely monitored as Nigeria's crude cargoes can be openly traded into Asia, Europe, or the US. Demand for Nigerian oil has been affected by heavy refinery turnarounds in Europe, leading to an excess of April barrels entering the current May trading cycle. Competitive rival producers in the Mediterranean have also impacted Nigeria's sales. In contrast, Angola's May loading crude has seen steady demand from buyers in Asia, such as China and India. And finally, in 2023, the Central Bank of Nigeria maintained the cash reserve ratio at 32.5%, leading to a substantial increase in restricted deposits for Zenith Bank PLC and 9 other banks, reaching 17.1 trillion naira. This represents a significant growth of 72.7% from the 9.91 trillion naira reported in 2022. The CBN uses the CRR as a tool to regulate the country's money supply, inflation level, and liquidity. The higher the CRR rate, the lower the liquidity available to banks. The CBN's Monetary Policy Committee, MPC, increased the CRR to 45% in 2024, aiming to address double-digit inflation rates. This move has drawn criticism from shareholders and banks as it affects their profit and revenue. Chairman, Progressive Shareholders Association of Nigeria, PSAN, Boniface Okeze, said shareholders have been advocating to CBN to pay interest to these banks. We'll take a break now. When we come back, we'll bring you Market Watch. Stay with us. You're watching Business Edge. Nigeria Stock Exchange suffered its biggest one-day drop in over 2 months. The main index shed 1.93%, the steepest decline since February 19th, closing at 99,808.34. Selling pressure hit the telecom giant MTN, which fell 1.32%. Major banks also took a beating, with GT Bank dropping 3.66% and FBN Holdings sinking 5.61%. The slump eroded year-to-date gains, bringing them down to 33.48% from 36.11% the previous day. The total market value of listed stocks also shrank by 1.11 trillion naira, closing at 56.45 trillion naira. Now let's take a look at the numbers, seeing what we have beginning with the all-share index. And so for the all-share index, the first decline we have there is minus 1.93%, and it closes 99,808.34. That was from yesterday's market activities. Let's take a look at the market capitalization now. So for market capitalization, we also see that sort of decline. We see 56.45 trillion naira. And now let's take a look at the top traded stocks yesterday. Well, the top gainers from yesterday's market. We see Morrison, 9.96% increase. Thomas Wyatt, 8.63% increase. Universal Insurance, we have it there, 5.56% increase. Ometech, 3.8% increase. And NSL Tech having 3.4% increase. We see the prices that closed out yesterday. And then let's take a look at the top losers from yesterday's market. For the top losers, we have Cornerstone right here losing 10%, Mutual Benefit 10%, Tantalizer 10%, Unity Bank 10%, Jay's Bank 10%, and this also represents the amount the stocks closed yesterday. Now let's take a look at sectoral performance so we can better understand what happened yesterday at the market. For the sectoral performance, we see banking dropping 5.75%. I remember before now with the announcement of recapitalization of banks, some analysts sort of talked about how that this might help the banking stocks, but we're seeing the reverse. And to a very large extent, we're also talking about, having the results from these stocks, that's from the banking stocks. The results are out now, and we're not seeing any commensurate, sentiment, towards that particular stock. Well, it tells you that investors are, of course, looking at these numbers, and they really care about this recapitalization. And they want to see, what will happen going forward. That's why we're having banking stocks taking the hit there, 5.75%. And then for insurance, we have it 3.27%. Everything is just in the red, with oil and gas maintaining its 0.00 unchanged stance. Then consumer goods minus 1.02%, and then industrial goods minus 2.70%. Well, that's what we have from yesterday's market. Market has, of course, resumed. Market activities has resumed today, and of course, we'll bring whatever happens today tomorrow. We'll take a break now. When we come back, we'll have our first conversation for today. Stay with us. You're watching Business Edge. For the 8th consecutive session, the Nigerian bourse extended its losing streak as the benchmark index closed 1.93% weaker, the biggest single-day decline since 19th February, to close at 99,808.34. The market's weak performance was driven by sell-offs in telco heavyweight MTN Nigeria, which lost 1.32%, alongside tier 1 banking tickers. We've got GTCO, FBN, and we also have Access Bank there. Now, as a result, the year-to-date return fell to 33.48%, while the market capitalization lost 1.11 trillion naira. Well, we have joining us right now Vincent Oshoma, the head capital market at Interstate Securities. Thank you, Vincent, for joining me today.
Thanks for having me. Good morning.
All right. The first thing that came to my mind when I saw this is the fact that these things are not just numbers. These are, people's investments we're actually looking at right now. What's going on?
Is the market reacting to some of the recent events in the market, in the economy, in the financial system? You know that the last meeting, CBN increased rates. And we have seen uptick in rates in the fixed income space. So it's people exiting the equity market to go into the fixed income space. That's why you are seeing this rate. And also the recapitalization has also thrown some uncertainty in terms of how they are going to see it pay out, because the banks have released some of their plans. But we don't know the timing is also something that people are looking at. And also when you also look at the latest inflation figures that show that inflation is currently at 3%. So, and with the hawkish stance of the CBN, I think all these events is kind of what is impacting our market.
Well, the thing is, I must say that analysts actually anticipated a slowdown driven by 3 factors. That's a rising fixed income yields, which you talked about due to CBN rate hikes. And then we also have this particular one, decline in dividend payouts compared to Q1, and then the potential dilution of banking stocks due to the recently announced recapitalization exercise. Now, are all of those things playing out now? You've mentioned about 1 or 2 of them. Now, let's take the dividend payout. Are all of these playing out now?
Yes, the dividend payout has an impact, especially when you look at the dividend payout of some of the banks. When you have GT paying final dividend of 2.70 kobo, I think that was quite shocking for most investors compared to Zenith Bank paying 3.50 kobo. I think we saw the impact on the stock of GTCO, also Access Bank, and you saw when UBA was paying 2.30 kobo, we saw a move in the price. But at the end of the day, investors also have to look at what is happening in the fixed income space, and we saw, despite the impressive result and a huge dividend payout, we saw investors exiting the equities market for the fixed income market.
Before I take you on that, I remember before now, I'm almost tempted to even talk about the analysts that actually talked about this, saying that, the banking recapitalization news would spur positive sentiment for the banking stocks. But the opposite seems to be the case. Is there something we're missing? I mean, are they getting something wrong by their projection?
Yes, I think it's definitely going to impact the banking stock and also the market generally. But like I mentioned, is the timing, because when you talk about the recapitalization, it's a good thing. It's going to impact the market. But coming at this time when we have the high rate environment, people will be looking at the return on investment that will be expected of the equities might will definitely be higher than what we have in the fixed income market. And when you look at the current prices and current yield, I don't think dividend yield, I don't think the current dividend yield is comparable to what you have in the fixed income market. So people are looking at this information and they are making that decision based on that. But I think as it depends on how the banks are able to roll out the timing of their recapitalization program, I think that will also help investors in analyzing the market and making decisions.
All right, you talked about dividend yield, but I know that's not the only thing to consider. What happens to capital gains? But that's also going down, if you ask me. So now, are we seeing a respite anytime soon? I mean, what policies or company news can change the tide in the market? You talked about, some of the things that might, spur that sort of sentiment that we want to see. But how soon will this happen?
I think we are expecting the Q1 results of most companies by the end of this month. But beyond the performance that will be expected from those Q1, I think the people will continue to look at what is happening in the fixed income market. That is expected. We have seen the CBN talked about increasing rates to attract foreign investors and also to stabilize the FX market, which we have seen relative stability in the FX market, which the Naira gaining value. And we expect that to start affecting the inflation, because for March inflation, you saw that inflation went up even beyond expectation to 33.20%. So as we continue to see inflation figures, maybe at the end of this month, the inflation for April, and also what CBN does with rates, I think those are the factors that will affect the market. But if you look at what happened in the auction, the bond auction, and also the last Treasury bill, it shows you that rate seems to have peaked. And they tend to start rolling down, because the last NTB auction, if 1 year TB was at 20.something% from 21%. So that tells you that rates kind of peaked. And also, so the bond rate on Monday showed that for the 10-year bond, it was at 20%. Previously, it was at 21%. So that tells you that they will start seeing rates tinkling down. And definitely, that is what the market we can affect investors in the capital market, coupled with the results that we expect from the bank. But with what has happened so far, because you know that full year 2020 result was actually spurred by what happened with terms of devaluation of the currency. So a lot of the banks made a lot of money from FX gains. We don't expect to see that in Q1 results. So I don't think we'll see a lot of surprises in their result for Q1 provide that catalyst to push the market upward.
So what's the way out really for people who are probably vested in that stock? I mean, we cannot overemphasize the importance of a diversified portfolio at this point. I can imagine what this probably means for investors who have banking and telco stocks. What are your thoughts for them? I mean, what should they be doing at this point?
For investors in that space, what I would say is that, like I'm trying to advise some investors, is that for those, because what we have seen is that those that we invested at lower levels are exiting the market and trying to move in it. But for those, I don't think it's a time to panic, because when you look at these companies, there's still a lot of value in those coins, right, for the banking stock. And if you look at the only thing why we are seeing expecting a dilution in the equity holdings is because they are going to be raising more money. But in terms of their shareholders, you can see their balance sheet is quite huge. Most of them have balance sheet of over 2 trillion. Some of them have over 1 trillion, which if the CBN allows them to use their complete shareholder fund, they should be able to meet the capitalization easily. But it's just because CBN is paying attention to paid up capital share premium. So I think they are still in a good position. And also when you look at their EPS, they're talking about 20 Naira EPS, and some of them at almost 20 Naira. We expect to see lower EPS, but it's still going to be good. So I think they still have a lot of value that people can look at. But just because of what is happening in the fixed income space. That's why people are exiting. And also with the increase in rates, people are also looking at the foreign investors that we expect to start coming to the equities market. They'll also be looking at that. And finally, the last figures from America that talks about inflation with surprise increase in inflation in America. And so the expected rollback in rates in America is not going to come very soon. I think those are also factors that people are looking at, and it's affecting the equities market.
Okay, so in closing, we always talk about savvy investors who know what to do at every point, in time, when to buy, hold, or sell. I would like you to talk to us about these dynamics. So, some of us who are not as savvy will know not to sit and watch our investments go up and down, right before our noses.
Yes, I think for those that are looking at the market, there are still opportunities in the market. Looking at the bank, like for now, this morning we saw some of the banking stock trying to pull back because of what they suffered yesterday. So we expect to see some pullback, but it will not be it will be trading relatively flat because investors, profit takers, will be looking at what happens in the market. So I think it's a market for short term, for especially those that are going to be looking at trends in the market, for short term to trade, short term for those that want to trade. For those that are looking at long term, they can still look at the market for long term. There's still, like I said, still opportunities in the market for long term. But for short term, they have to just look at the market and exit whenever there is some relative gains in terms of their portfolio. Then for outside the banking stocks, I believe that as we start seeing more interest in the market with the capitalization, a lot of other companies, and also when we start seeing improvement in the economy once for inflation and also for the FX market, we definitely start seeing improvement in other banking stocks. Also, some stocks like the telcos and some of the that are trying to resolve their negative shareholders fund. I think their meeting that we'll be holding at the end of the month will also have an impact in what investors will be looking to doing with respect to their stocks.
I'm just imagining what will happen if the CBN prefers another rate hike. That means the stock market will take another hit. Isn't that what it will be?
Yes, looking at current scenarios, current events, would I expect to see the CBN increase the hike rate shortly, because when you look at the inflation figures, though there was an increase in inflation, but when you look at the month-to-month inflation, it started slowing down. And also, that a lot of the inflation is pushed by what is happening in the forex market, devaluation. And we have seen the Naira reverse from 1,500, 1,600 levels to just above 1,000 levels. I think that's a good thing for the economy. So once these things start trickling into the economy in terms of prices, we expect to see inflation coming down. And with inflation coming down and relative stability in the forex market, we don't expect the CBN to hike rates, because hiking rates definitely will affect the economy. So you cannot continue to hike rates and light affecting, because businesses will not be able to borrow. The manufacturers are already complaining about that. So I don't expect to see them hike rates once we start seeing inflation coming down and also stability in the FX market.
All right, just before you go, finally right now, what is that thing that we should be expecting, to cause that particular change? When should we expect some positivity in the stock market?
Yes, like I said, the rate is impacting. The another thing that I think will affect is once the banks, because some of them are started rolling out plans in terms of their proposal for recapitalization. I think after more information comes out in terms of the timing, there are meetings that are being proposed shortly that to approve it with respect to the timing and respect to the price that they are going to raise for those that want to do right issue, and also the price. I think it will definitely have an impact on the market, because in the absence of those information, I think a lot of investors are looking at the future and with some level of uncertainty. I think that's what is affecting the market, and also what is happening in the fixed income space. While there's a lot of clarity, better clarity with capitalization, I think it will have an impact on the market. And also the meetings that have been expected at the end of the month, like MTN holding the meet shareholders meeting to discuss its negative shareholders. So I think that will affect their stock that we saw for Accra and the others.
All right, thank you so much, Vincent Oshoma, head of capital market at Interstate Securities. Thanks for your time and your thoughts. All right, we'll take a break now. When we come back, we have another interesting conversation for you. Stay with us, don't go away. Glad to know you're still with us. Nigeria's inflation rate hit a record high of 33.2% in March 2024, a 1.5 percentage point increase from February. While the monthly rise slowed slightly, the year-on-year increase remained significant at 11.16%. Food prices continue to be the primary driver, with inflation reaching 40.01%. This surge is fueled by rising cost of essential staples like garri, yam, and millet. Urban areas are experiencing the brunt of inflation with a year-on-year rate of 35.18% compared to 31.45% in rural areas. Now, adding to the concerns, core inflation, excluding volatile food and energy prices, also rose considerably to 25.90% year-on-year in March. Well, joining me for more on this is Benjamin Boachie. Benjamin Boachie is the Chief Economist at SecondSTAX. Thank you, Benjamin, for joining me today.
Thank you for having me.
Well, Nigeria's inflation rate hit a record high of 33.2% in March, and that's a 1.5%, increase from February. But when compared to February's month-on-month increase, we can see a slowdown of some sort. Is there something to be excited about?
The number is still very high, so probably I wouldn't say something to be excited about. But it could be evidence that at least the first rate hike has starting to take some effect, and that's certainly something we could be pleased to see.
All right, well, talking about the rate hike, which you already mentioned, the CBN recently increased MPR by 600 basis points. That's when we took a look at the first and the second, which happened this month. And that's particularly to combat inflation. Yet, inflation seems to be trending upward. And some analysts have actually identified factors such as socioeconomic influences, delayed monetary policy response, and of course, sticky price dynamics as culprits here. Do you share the same sentiment?
I certainly believe that the Nigerian economy was done a very real disservice by the MPC when they went 7 months without holding an MPC meeting. If these rate hikes had begun much earlier, I think a lot of the worst impact of inflation could have been at least averted to some degree. So I certainly agree that the delayed policy response has been problematic.
All right, I'd like you to talk about the role that these factors play. You've talked about one of them, which is the delayed response. But let's look at sticky price dynamics. Let's talk about it. I mean, how does it play out here?
Well, so, local goods and services aren't as impacted by the strengthening of the Naira, right? Because these are folks whose costs are in Naira and their revenues are in Naira. So relatively, that's not necessarily going to make the difference. When you have imported goods, you can substitute out often. And when the Naira rises, the relative cost of these imported goods goes down. So a lot of the staples that you mentioned earlier, garri and some of these food items that are staples, these are local goods. So when the inflation is concentrated in these areas, it can be very sticky and very difficult to bring down.
All right, well, for many Nigerians, numbers may not necessarily mean so much. What they want is a decrease in the prices of food, commodities, and services. And we also know that recently, Naira was named the best performing currency in April, with Goldman Sachs expecting it to trade below 1,000 Naira. And we see that, this is probably not even translating to reduction in prices of food items. You've tried to explain that dynamics by saying, we have the Naira angle, and then we also have some imported goods and all of that. But talk to us. I mean, at what point should we begin to see the needed change that we want to see?
Oh, that's a very difficult question to answer, in terms of specifically when this problem gets solved. It's as we've discussed, there are a lot of different moving parts that determine what the ultimate inflation rate is. And even, the inflation rate for one person isn't necessarily the same for another person, depending on what that person's specific costs are. So it's tough to say exactly when, but, the answer are two things. It's monetary policy and it's fiscal policy. So, the longer the central bank maintains a really hawkish stance, the more likely you are to see inflation come down, even though.
Benjamin, I do not think I would like you to continue because, I mean, this is a conversation I've had with a lot of persons and they do not want to hear another rate hike. For them, this is going to be catastrophic for the economy. Even the person I just spoke to minutes ago also said something about, when I asked him about the CBN probably increasing the rates, and now you're talking about the CBN continuing on this trajectory. I'd like you to please explain that.
Yes, they do need to maintain a hawkish stance, but it's not only the policy rate. That's not their only tool. And I think another disservice that the CBN has given is that they're not really using some of the other tools. Just being very clear about how aggressive you're willing to be for as long as it takes, just a more aggressive posture, even if you don't necessarily pull the lever on the policy rate. That clarity can be very helpful, and just explaining, where in monetary policy they will be willing to be a little dovish and where they will be hawkish, right? So you may end up wanting to liberalize things a little bit for the banks, even if the headline. Even if the policy rate number goes up, right? There are different sectors of the economy they may want to try and favor in order to get the right combination of policies to help out. But overall, with inflation in the 30s, you can't really start to ease until you see some improvement there, because if inflation gets out of hand, and I mean, 30%, that's not the highest inflation it can go. It can go worse. So they absolutely need to make sure that they maintain a hawkish enough stance so that they keep inflation expectations anchored to the downside and they don't let it get out of hand.
Okay, I like what you said about having a combination of the monetary and the policy authorities, doing this together. But we've seen a situation where, the monetary authorities seem to be very hawkish. Now, it's not just MPR we're talking about. We're also talking about liquidity ratio. We're also looking at CRR at 45% for banks. We're looking at, liquidity ratio at 30%. And not only that, we also saw the bullish stance, if I can permit me to use that word, of the federal government in the fixed income market. And we know that when this continues to happen, if care is not taken, you are probably stifling the banks of their, of the wherewithal, to be able to go ahead with their intermediation role, financial intermediation role in the society. Not only that, we also have private institutions that you are crowding out of the market. When you look at all of those things, they don't look good. So if you're saying we need a balance, and that we're not saying, commensurate balance, don't you think it's also okay for the CBN to slow down so that the fiscal part or the fiscal authority can also measure up? Or what more do we need the fiscal authority to really do here so we have a balance, because it's not looking good?
Yeah. So, for this conversation, I think one of the things that you really want to keep an eye on is credit to GDP. Just get a sense of exactly how many households or what percentage of the economy is actually impacted by credit, by the cost of credit, right? That's one thing, because that kind of gives you a sense of whether it's monetary policy that's going to do the trick or whether it's fiscal policy. Now, on the other side of that, the Ministry of Finance does not need to wait for the central bank to ease before it can get aggressive in targeted fiscal response. So they work together. The monetary policy may need to remain hawkish, but the fiscal policy should come in to protect the most vulnerable, whether it's a minimum wage increase or very targeted subsidies, whatever it is. On the fiscal policy side, they can do quite a bit to alleviate the worst impact of the cost of living on cost of living, so they just need to work together, and they can get it right over the medium term to the long term.
All right, so we hear that FCCPC, let's say the federal government, really is planning to monitor prices of goods in the Nigerian market, and then we tie that to some of the things that have been established, factors that have been established as the cause of this inflation: food prices, road transportation, actual and imputed rentals for housing, consultation fees for doctors, pharmaceutical products and all of that. So do you think that measure is going to work? And what more should the federal government do to tackle some of these other things that I have highlighted rather?
Yeah, it's a very good move, right? Because like I'm saying, you want to essentially disaggregate policy, right? You want to start focusing on the very specific areas in the economy that will ease the cost of living and the burden on people. So getting all of this price data in a more high quality way will give them a better clarity and a clearer roadmap on the tools they need to deploy to bring down inflation and to ease the cost of living prices. So I commend that move.
All right, thank you so much, Benjamin Boachie, Chief Economist, SecondSTAX. Thanks for your thoughts and your time on the show today.
Thanks for having me.
We'll take a break now. When we come back, we have more for you. Stay with us, don't go away. Mozambique Central Bank has decisively cut its benchmark lending rate to 15.75% from 16.5%, setting a precedent as the first African country to slash rates twice in 2024. Now, this move highlights Maputo's aggressive push for economic growth amid a wider trend of cooling inflation and currency stability. Joining me for more on this is Eduardo Sengo. Eduardo Sengo is an economist and executive director, CTA, that's Confederation of Business Associations in Mozambique. Thank you, Eduardo, for joining me today.
Hello, thank you.
All right, so we've seen the central bank cut rate to 15.75 from 16.5. Now, that's the first African country to do so 2 times. Talk to us about this. What's this expected to achieve in the economy?
Hello, good day, everybody. Actually, no doubt, Mozambique Central Bank is leading the way across Africa in lowering the policy rate. We had tough times last year where the central bank increased the rate 3 times and reached 24%. So now we are in the reverse move. Actually, what's happened in the economy is that the inflation rate is decreased a lot. We went from about 9% to 4.1% last month, meaning that in terms of the decrease of the inflation was too rapid than we were expecting, particularly because Mozambique is importer of fuels, and those fuels, the market, in terms of the price of the market, are varying a lot. The volatility of those prices are really high. But the economy is doing well in terms of the inflation, what's happening last year, and particularly because the stability of exchange rate was very something incredible that reached last year. So those 2 components obviously increase the probability to cut the policy rate. In the public finance side as well, we can see that the 3 last months the government of Mozambique reduced the way is indebting, getting loans from the market, the bank system. That means that in terms of the treasury bills, also reduced the issuing the treasury bills for the market. So these also opened a way or a room for central bank to cut the rate. So
all right.
It was something incredible, but something that Mozambique really needs. We still have a prohibitive interest rate up to now, but the trend is very positive.
All right, let's talk about this now, talking about the interest rate. You talked about your inflation rate being at a single digit, and then the MPR is at a double digit. That's, I mean, when you look at that comparison, we'll get to that. But I'd like you to talk to us about how Mozambique has been able to manage its inflation and foreign exchange, because we see stability in your foreign exchange, and then we're also seeing inflation, deflating and all of that. And I think that's beautiful. How did you achieve that?
I mean, first of all, the central bank, they rebuild the reserves, the international reserve. That's what started point. We went from less than 3 months cover of the imports to about 5 months. This was the first thing. That this was a message that the country, in terms of the foreign currency, was strong, in a strong position. That is something important. Obviously, in this period, we had we started to export gas, natural gas, as you know, in the Rovuma basins. NEI project leaded project started to export this LNG. And this also brought revenues for the economy. Secondly, the imports last year that didn't increase a lot. Than if you compare in terms of total volume, if you compare with 21st, we see that there is a decrease, a little bit of decrease in terms of the imports. Particularly because first, the big projects, they didn't import it a lot last year. Secondly, because the fuel price created a space to cut the fuel invoice of import. I mean, we went from 1.9 billion US dollar of fuel imports to 1.4 billion US dollar imports. So this also impacted in terms of the demand of the foreign currency to cover the imports. So the pressure for the market was a little bit lower than other years. Obviously, in the same times, we have some regulations from central bank in the forex market, where some certain measures were established in order to, control the way the price is set, and this also affected the stability of exchange rate.
Great. Now, at this final. Okay, thank you. I wanted to say that we see a situation where your interest rate, again, is a double-digit figure, 15%, and then we have your inflation rates being about 5% or about. So talk to us. What's your expectation or projection for lowering, further reducing the interest rate? Or do you think it's okay where it is, looking at the fact that inflation you're targeting is almost, addressed?
Absolutely not. As I said, the interest rate is still prohibitive. And as you said, we still have a 2-digit interest rate while the inflation is 4%. So it means that we are about, if you count the reference rate and the inflation rate, you can say the real interest rate is about 11%. It's too high. No, actually, the Mozambique at the moment has the highest real interest rate within the pairs, particularly in the region, but even comparing other sub-Saharan African countries. So it means that we still have a room to move or to trend in the way that it can reach maybe very close to 1-digit interest rate in Mozambique. But there are risks in the market at the moment. As you know, this conflict between Israel and Iran and obviously other countries also joining in the Middle East.
Right, Eduardo Sengo. I'm afraid we have to end it here. I understand the global risks that you're also considering, and these are things you also have to, put up before you make these policy decisions. Quite understandable. Thank you so much, Eduardo Sengo, for your thoughts on the show today.
Thank you so much, mate.
Well, that's our offering today on Business Edge. Many thanks for watching. I am Perpetua Fasomi Peter. Bye for now. See you tomorrow.